Hi everyone, it's AJ with North Capital Mortgage, and today we want to cover first-time homebuyer loans, 10 things you should know prior to shopping for your home. So, as a brief overview, we want to remember that buying your first home is exciting, but it can also be an overwhelming process. So today we want to understand the loan basics. This will help us to save time, money, and stress. We want to remember that first-time homebuyers are those who have not owned a home in the past 3 years. So if you've owned a home for 20 years, but in the past 3 years you have not, you are going to be considered a first-time homebuyer. So let's go over 10 essential things that you should know about first-time homebuyer loans. Number one, down payment. You don't always need 20%. While 20% is ideal, it is not required. First-time homebuyer programs allow as little as 3% down. FHA loans in their standard capacity allow as little as 3.5% down, and USDA and VA loans may require 0% down if you happen to be eligible. So remember, the more down will be, and the lower your monthly payment will be as well. Number two, explore your loan option available for consumers. Conventional loans are the most standardized loans. They have excellent terms, and they will be as little as 3 to 5% down. FHA loans, as we mentioned, 3.5% down with flexible credit requirements. So if you have a troubled credit score or you have a higher debt to income ratio, an FHA loan may be suitable for you. VA loans are excellent for veterans of the military. USDA loans are available for rural homes. You do have income limitations on USDA loans. And then additionally, there's alternative or non-QM loans, which have expanded eligibility guidelines with as much as 10% down for a first-time home buyer. Number three, credit score matters. The higher your credit score, the better your rate will be and the better your loan parameters will be. So most loans require a 620 minimum credit score. Some allow slightly lower and some require slightly higher. As we mentioned, FHA down to 580. Conventional is generally 620, and alternative loans or non-QM usually will require a 640 credit score. The better your credit score, again, the better the terms of your loan will be, including a better interest rate. Number four, there's a lot here on this page. We want to take some time with this one, first-time homebuyer programs and grants. So first-time homebuyer programs are designed to make homeownership more accessible by reducing upfront costs like the down payment and closing fees. These programs are administered by state and local governments, nonprofits, housing agencies in the form of grants, forgivable loans, or special mortgage terms, which will help new buyers enter the market. Down payment assistance. These are programs that offer grants or forgivable loans to cover part or all of the down payment. State Housing Finance Agencies, or HFAs. Many states have dedicated agencies that offer programs for first-time homebuyers. Local government programs. These are cities and counties. They often provide targeted assistance based on income or the geographical area of the home. And then Fannie Mae and Freddie Mac, they have Home Ready and Home Possible, which offer lower down payments for conventional loans with flexible income requirements. And on all of these, there are qualifying limitations that may apply for first-time homebuyers. Number five, pre-approval is a must. So you should definitely not skip this step. When you are applying for a loan, prior to shopping for a home, please get pre-approved by a broker. They will provide you a pre-approval letter that details your qualifications based on their analysis of your documentation and of your profile. This will help you properly assess a budget before you shop for a home. A pre-approval letter makes your offer on any property substantially stronger. And nowadays, most real estate agents will likely not work with the buyer unless they have been pre-approved. It also shows the sellers that you are a serious buyer. Number six, you will need your financial documentation to be ready to provide to your loan broker. So you will be required to provide basic items such as recent pay stubs, your tax returns, bank statements to show your assets for down payment and closing costs, retirement account statements to show reserve assets if needed, employment history, employment verification, any Social Security or pension income, your IDs, and if you are currently renting, they will likely want to see the lease of where you are currently residing. So be prepared to provide current documentation. Number 7, closing costs. Closing costs add up. So on any home, you can generally expect to pay about 2 to 4% of the home price in closing costs. And that's not directly to your broker or directly to the lender. It's to a number of different agencies, such as, again, lender fees, title and escrow fees, to the appraiser for the appraisal. You will have to pay tax and recording fees to the state or county, and prepaid interest on your loan for the closing month. If you are going to have an escrow or impound account where you pay taxes and insurance monthly through your loan, you will have to prepay taxes and insurance, usually at least 1 year of insurance, and could be up to 6 or 7 months of taxes on your property. So the good news is these fees many times can be subsidized by certain down payment assistance programs or even seller credits if your agent negotiates that for you. Number 8, understanding mortgage insurance. You've probably heard of PMI or mortgage insurance. So private mortgage insurance, this is an insurance that protects the lender, not the borrower, but the lender, if the borrower happens to default on the loan. Borrowers will pay a monthly premium to the bank as part of their monthly payment. Sometimes you have the option of paying this as a one-time upfront fee, which will be substantially larger than any monthly payment. And this is going to be required. PMI will be required for any down payment that is less than 20% on a conventional loan. FHA loans, you will have PMI regardless of the down payment. And on FHA loans, you will also have something called upfront mortgage insurance premium, which is roughly close to 2 points of the loan amount, which will be financed into your loan. The VA loan does not have PMI, but it does have an upfront guarantee fee. And once your equity in your property, most notably on a conventional loan, hits 20%, you do have the option of canceling your monthly mortgage insurance, but you will have to work with your servicer to do so, and there may be a number of steps involved in doing that. Okay. Number 9, you should budget beyond the mortgage. So there are more expenses beyond the down payment and beyond the closing costs. Again, property taxes, depending on the location, you could be anywhere from 0.75% to maybe even 2.5% annually of the purchase price. So part of this will be prepaid into your escrow account. Homeowners insurance can vary vastly. I've seen anywhere from $800 or $900 a year to $8,000 or $9,000 a year, depending on the property and depending on the location. So definitely you want to get a quote from an insurance agent so you know in advance how much your insurance will be on any particular property that you're interested in. Maintenance, repairs, upgrades, or hidden costs after the purchase. Many times you'll make a purchase on a home, and after you've moved in, you will note that there are certain things that you will need to get done that you may not have been aware of prior to the purchase. And again, customization, furniture, those sorts of things, you want to make sure you budget accordingly for that. Number 10, basic qualifying parameters of first-time homebuyer loan. So you're going to have a debt-to-income ratio, which you will need to meet. This is your gross income divided by your total monthly expenses, including your new mortgage. So whatever your gross income is divided by all of those expenses, you're going to want to be, again, depending on the loan, anywhere between 43 to 50% will be standard for debt-to-income ratio. Credit score and depth. You want to make sure you have established trade lines. Most banks like to see 3 trade lines open for at least 12 months. That can show them that you have established the ability to repay, whether that's a credit card or a car loan. But it is important to ensure you have trade lines available in the credit report. Employment and income stability. So banks want to see that you've been in your field for 2 years. So let's say you are a nurse. You may not necessarily have to have had the same nursing job for the same facility for the past 2 years, but they want to see that you've been a nurse for 2 years. So they want to see that you have stability in your field and that income is likely to continue. Assets. So when you make a down payment on a home, the bank wants to see that you have seasoned assets. So they're going to want to see that you've had those assets in your bank account or in your name for at least 60 days. And that it is not simply funds that are handed to you by somebody else. You can utilize gift funds from an immediate family member, and those don't necessarily need to be seasoned. However, a portion or all may need to be seasoned from your personal account. So those are 10 things notable for first-time home buyers. If you have any questions at all, or if you're interested in getting pre-qualified, please reach out to me at any time. Again, my name is AJ with North Capital Mortgage, and I appreciate your time very much. You can email me at info@northcapitalmortgage.com or reach out anytime at 714-624-5151. Thank you so much, and I appreciate your time.